Hey guys and girls, it is Nathan here from the B.Invested headquarters, and today we are going live for our Tuesday night live chats. Got a bit of a different sort of mix up today. I'm going to try something a little bit different. Play a video, going to review a video with you guys, going to go through the news as I always do. I want to talk about tonight what is happening out there in the financial markets. And I want to have a few things that are really clear, out there, because over the years, I've copped a lot of hate, right? I've copped a lot of people that try and say, oh, Birchie, you're wrong, or whatever the case may be. Um, I don't profess to get everything right all the time. I think I do a good job of looking at data and analysing where financial markets are at and trying to get a good grasp on it. And for me personally, I'm very heavily invested into the financial markets. Right, I'm very heavily invested. I've got hundreds, going in the hundreds of millions of dollars worth of assets. I've got a large level of debt, a small amount, but it's still a large amount. It's 20 mil thereabouts in debt. So I need to know how these things sort of work. Interest rates go up, I lose money. Interest rates go down, I make money. And there's waves and cycles. And going back 2018, I came out with a concept called the GFD, which is a global financial depression. And at the time, I said it was going to be of biblical proportions, right? And people said, get off the drugs, Nath, get off, you wished this would happen, whatever. And basically, I talked of the premise in the global financial depression that we would see a crash, which would be one of two things will happen. It'll either crash, all financial markets will crash, or we will see the mother of all booms, because they will print their way through this and we'll end up with a thing called a hyperinflation. And at the time, people said interest rates will never go to zero. People said that interest rates will not go negative. Hyperinflation, you're off your head, going to unsubscribe and unfollow you and all this sort of stuff. And fast forward to 2022, here we are in a world where we've seen zero interest rates for 2 years, 3 years now. We've seen inflation at levels where most of your goods have gone up by double or triple. In the when I say double or triple, like you look at property, you look at your petrol, you look at car prices, you look at certain things. Everything's going up at a very fast rate. And people have been saying, when we're at 0% interest rate, Birch, you said that interest rates would go negative, and they didn't, and you're full of shit. Well, they went to zero, and this is when they were saying at the RBA that interest rates were going to go up as the next move. And now interest rates are sitting at about 285 basis points. And people are like, Birchie, you said the interest rates won't go back up again. You said we're going to hyperinflation. Why aren't we going there? And, the road to where we're heading with a hyperinflation is not linear, right? Nothing in our lives is linear. And pretty much the amount of liquidity that's out there that's sloshing around, they've manipulated it way too far. It's like, I remember this ad that was on TV many years ago, and it was about speeding. And it says, if you're driving 60 Ks and you have to fly off the road, you'll avoid an accident. But if you're driving at 70 Ks, you'll fly off the road and hit a tree. And if you think about it, right, the faster you are driving your vehicle, and the slight movement, the faster you're driving, the trajectory that you're heading into, there is less room for you to be able to make an error and be able to swerve out. Otherwise, the car will go totally off course. And I think if we reapply that to the financial markets where we're at, there's no room for error anymore. We had a thing called ZIRP, which is zero interest rate policy. And basically, the world is addicted to cheap, easy credit. And everyone is using it. So any slight movements will be catastrophic and exacerbated with the trajectory of where things are going. So purely when I come to the conclusion that we're heading for a hyperinflation, we're heading for interest rates to go negative, it's basing on, okay, what can the market accept and what is the stress test that can be applied to it. And yes, we've got higher interest rates at the moment. Will they be around forever? Will they not? I've got some charts here, and I pulled these charts out recently, and I've drawn it on a couple of them, and I'm going to refer to them a couple of times tonight. throughout our presentation. So this one here is just the interest rate chart over the last 30 years. This here is in the 1990s, and it went up to 7%. This is the RBA, went down. If you notice that every time it goes down and it comes back up, it doesn't really get to its higher highs. Every time it hits its last high, right? So it goes up and then down, then up and down, and then it goes up above this old high level here. And then we have the biggest crash that you've ever seen. And then it goes up a little bit, doesn't go back to where it was before, and it comes back down. We are now sitting at a point where they have thrown us all the way up, right? And that ain't going up in a step pattern like this or a step pattern like this. This is just overnight. Um, so if we look at the trajectory, if we look at the longer term trend lines here, that's like 15 years, that's like 20 years. You can see the trend of interest rates is going down, and now we've busted that trend line and smashed straight through it. But it's not in a position. The market is not financially in a position to be able to accept that interest rate. And I'm going to go through that this evening. I've got a really cool video here that one of my viewers and one of my investors have sent over, which I think is important for everyone to look at and listen to understand this, as I want to get you up to speed, because I'm seeing people now going, Birchie, you said that interest rates were going down. How come they've gone up? And I calculated that would have the potential to go up 50 basis points from the point where we were a few months ago. And here we are, we've gone up 285 basis points, or 275 from where we were at 10 basis points. And it's going to end up very catastrophic. And I think 2023 will be an exciting year. And all this data that I look at, sometimes I sound like I'm off my head. Sometimes I'm like laughing about things. I'm really excited and really optimistic about the world that we see, because I just see that it's not anything to do with your property, my property. It's based on the decisions that we make and understanding that fundamentally we're playing in a banker's game. This is a financial market, and there's certain things that happen in these markets, and there's only certain outcomes that can be prognosticated through this. So here's that chart again that I just shared with you guys. And I just want to share it for all the scaredy cats out there that are thinking that the sky's going to fall and the interest rates are going to go up and all this sort of stuff. I've just got here from the peaks of where the interest rates have gone up. So we've got this one here. And if you just think about the percentage of interest rate going up, right? Yes, it's gone up by 2, and it's gone up by 3% here. And it went up pretty quick. It went 1 time, 2 times, 3 times. 3 times it went up like a percent. Problem is that that's only gone up 50%. From the starting point of where we're at down here, it's gone up from 10 basis points to 285 basis points. That means that an interest rate or a cash rate has gone up 2,850%, right? It hasn't gone up 50%. It only went up 50% here this time. It went all the way up. This time it's gone up 2,850%. This cycle here lasted for about 1.5 years that I've calculated here. And then we had the dot-com bubble, which busted. And basically, if you think of back in early 2000s when the dot-com bubble, for those of you that remember the Y2K bug and all the interesting things at the time, if you take a look at this chart here, basically when they started tightening monetary policy, that's when the Ponzi market of the dot-com bubble and bust happened. So for those of you that weren't born at that point, I was only a kid. I was in like year 10 at school or something. Basically, there was a big recession based on the fact that all the internet companies, all the computer companies, all new tech, everyone speculated on it basically like a Bitcoin and crypto market, and it was called the dot-com bust. But we saw here that they pushed up, they tried to tighten monetary policy, they couldn't even do that, and we had a massive recession at that time. They dropped rates, put all these stimulus packages in, and then we saw a big boom, and they just slowly dragged it out. And we were actually in a recession from about 2004, which is about here, all the way up to 2007, when we saw the GFC. If you note that they pushed the interest rate up so high, they took so much liquidity out of the system, we saw a very dramatic crash. So you can see how quickly. So this one here was about 1.5 years. This was 6 months. This took 6 months for the market to go up and then crash, right? And then we have this one here that took a long drawn out process, but when the market hit a roof, it crashed within, from going up here, the last leg of it, 3 months, 6 months, and then we had the GFC, everything crashed. and it can never get back to its all old time high. So the question mark that I have here is this one here is way off the long-term trend line. And how, in a world with so much credit and debt that's out there, can this be sustained and supported? And on that note, that's going to be the whole of tonight's video. I'm going to be playing a video, I'm going to be talking about a video, and we'll get straight into that. But just before I do so, I've got a few little news articles I'm going to run past you guys just for a laugh, just to share these sorts of things. I get excited about the prospects of a recession. I get excited by the opportunities there. It is not the problem that is the problem, right? It's going to be the cure to that problem. And people will be sitting there thinking, oh, we're going to get cheap property. So 2 years ago, 3 years ago, whenever it was, world went stupid, everyone was stupid. And people thought, okay, property price is going to crash by 40%. Is that the next thing? All they did, and there's specific reasons, and they're in this video that I'm going to share with you this evening. There's specific things that occurred which stopped a market from going into the red, and basically, you know, it's a bullet that it's a treatment that's going to be the problem here. And I said it from the start when they started printing money back, many years ago, as Corona first started, and just before Corona had just started. So this article here is from the Sydney Morning Herald. This one's a funny one, right? And I've contemplated with the idea of doing a class action against these guys at the RBA, right? Because these guys here, I'd have to go and speak to some of my lawyer friends and that to get a bit more understanding on this. But the RBA came out and said that interest rates will not be increasing until 2024, and a lot of people have put a position of reliance on the fact that, okay, interest rates, this guy here's been giving me advice. So is this guy an accredited financial advisor? Is he an accredited financial planner? Is he a person that's able to give you that advice? Who is he? He is the commie called Philip Lowe from the RBA. And he said, this is his apology. So it says, the Reserve Bank Governor apologies for interest rate comments. Reserve Bank Philip Lowe has apologised to thousands of Australians who took out mortgages and expect interest rates to stay unchanged until 2024, saying the economy recovered much quicker than expected from a dire situation. The economy never corrected. The economy was never strong. It's always been fake since the time that we can remember back. Probably the people that are no longer here, because it's been like 100 years since there was any sort of form of sound money where they made solid money, that the economies have all been fake. That's why they're called fiat. Fiat is fake, so it's a fiat currency. Low giving evidence to the Senate estimates the committee for the first time the RBA had failed by not making it clear that its commentary about steady interest rates was heavily conditional on the state of the economy. So they're admitting now that they were wrong, right? And they've misled thousands of people, and those people are now, in a dire situation or whatever the case may be. It goes, the governor has come under fire of the rapid increase of interest rates since May this year. This cash rate has climbed from 1.1% to 2.85%. Markets expecting another rate rise next week. But as late as November last year, Lowy was signalling the bank was likely to hold the cash rate steady until 2024. Lowe said borrowers had clearly heard the Reserve Bank's comments about 2024, but not that it could change depending on the economy's health. I'm sorry if people listen to what we'd said and acted on what we said, now regret what they have done. I'm sorry that it's happened. Anyway, I think you get the picture, right? They've made acknowledgement of it, right? So there's a bit of outrage and crying about it and all that sort of stuff. But the thing that I get excited by is that as they're sucking all this liquidity out of the system, it is causing a lot of pressure out there and a lot of pain. And yes, that'll cause people to get into trouble and all those sorts of things, but ultimately the bigger the problem that they cause, the bigger that the cleanup that they're going to have to do to fix that problem that they've occurred. And looking at the problem that that's occurring here, it's very clear that this is out of line and the market cannot support this. And I mean this in certain different ways. If you think about if someone was out there to lend money, right? If someone was lending currency to an institution, into a stock listed company, or whatever the case may be, like if you're an investor, you've got $1 billion, right? Would you want to go and invest it into some tech stock or into some public listed company, into some property, and anything that has counterparty risk attached to it? you would sit there and be like, okay, there is a risk. Now, if the bank was to say to you, okay, we'll pay you 3%, 4% in a more safer 3 month, 6 month bond sort of style, and there's going to be a recession that's potentially ahead, you would think, okay, well, I'll keep my $1 billion and park it on the sideline. So now we've got people, or we've got institutions out there sucking liquidity out of the system because they can go get greater return on their investment elsewhere, and they're looking at the opportunities that they can pick up with having easy liquid cash. That is having a flow-on effect. And I've got numerous amounts of articles here that I'm going to share with you. And I've talked about job losses many, many times. And I've been a bit excited by it because I see the prospect that we can grow our businesses, right? I've seen that some of the largest companies in the country have employment of about 45,000 people in their business. I've got a couple of hundred staff, very small, but I see in the next 5 years, 10 years, 20 years, I talk about leverage of capital and leverage of other sorts of things. What is very important, you can leverage anything. You can leverage your time, you can leverage your resources, you can leverage people. And the way that I see, being able to grow a business is, I'd love to say I'm as great as I can be, but I'm only as good as what I've got as a team around me. And the more that we can grow our team, the more greater things that we can do, and the bigger the community we can do, and the bigger the impact. So the more people coming would be better. There are layoffs everywhere, right? So what we've got is a world of high interest rates, high petrol prices, high food prices, business people tightening their purses, and they're not spending their money elsewhere. And then we're seeing liquidity, and there's a big credit crunch, bigger than 2009, that is occurring, bigger than 2007, bigger than 2006. We're at 2006 in the GFC right at the moment. There is, once again, two things that they can do, and this is the last cycle that they will have in their currency. I said that when we see the next recession, you can go back on my videos 3 years ago when I did the whiteboard session about the hyperinflation that's going to come. I said it wouldn't occur before 3 years, and it wouldn't come more later than 7 years after that. And that'll just purely come from the next way of injecting liquidity in the system. They're just going to print so much of it, it's going to totally lose all the value of those currencies. So we're starting to see the demise of our currency, and we're going to see that rapidly increase over the next few years. So this one here is some article, I forget where it's from. It's from like, I don't know, AFR, yes, AFR. And it says here, waves of redundancy sweep through the local tech market. Peter Gomes felt a stinging sensation of rejection when he was laid off by Nimble in Australia. So Nimble is some sort of bank, I believe. It's a tech bank. The 34-year-old tech professional was caught up in a wave of redundancy in the payday lender in September. So this guy, it's a payday loan. And so the payday loan company, imagine the people that need money right now, the payday loan goes bankrupt, right? So he was laid off. I don't know if it's gone bankrupt or not, but he's been made redundant. Even Nimble said it was nothing to do with my performance. It was just because the company had restructured and was trying to save money. As interest rates rise and access to capital tightens, Nimble is far from the only tech employer to cut costs by laying off workers this year. Tech giants Amazon and Meta, I can't see it's cut off here, have all had their I can't see it. It's basically saying that the other tech companies. I got really sad with this whole situation because I knew I was good at my job. Even Nimble said that it was nothing to do with my performance. It was just that the company had restructured, was trying to save money. Why were they trying to save money? Because they don't have any money, right? So scary outlet. Mr. Gomes, who's landed a 3-month contract with a modular building company, Osco, since losing his job at Nimble, said the outlook was scary because riding the ups and downs of the tech industry appealed to him more than pursuing a career beyond IT. Leaving the sector would be a waste of his skills and experience, he said, having cracked open his first computer at 6 years old, said fixing things can easily come to him. His redundancy is an illustration of the wider slowdown in the tech industry as startups that went on a hiring frenzy last year realised their growth targets were too ambitious and they are now need to focus on their improving efficiency. So I don't know if you've raised capital beforehand in a business or gone to the bank to raise capital, whatever the case may be. People ain't just going to go, oh yeah, you sound like a great bloke. Here, have another $1 million, have $5 million, have 50 million, have 20 million, have 100 million, have $1 billion. They don't just sit there. They sit there and go, okay, how can I strap this thing into my business? How can I strap this guy up and get his legs and his nuts tied together, right? They look at opportunities like that. So they don't just sit there and go, okay, we'll just throw some money. They want to see the business plan. They want to have investment in the business. And now we're seeing these things disappear, right? And why are they disappearing? It's not because the business is not performing, because it wasn't performing beforehand. Um, so it goes on to say, Mr. Jones said the tech hiring market had cooled since it peaked in June, but the demand was extremely high for cybersecurity, blah, blah, blah. So it's interesting, he says here, the market had cooled since its peak in June, when we started seeing interest rates rise in March, April, May, right? The flow-on effect from that. Interesting anyway. Goes in, companies trying to get fit. The threat of recession next year is making companies go, okay, we've actually got to get fit again. We've got to think about what we're going to do next year to achieve the same but better outcomes in 2023 than we did in 2022. We're going to have to work a little bit harder and a little bit smarter, right? That means that you're going to be not getting remunerated as much as what you were beforehand, because things are a lot tighter out there. That's what it converts to in layman's terms. So interesting to see that. So we've got job losses over there. Then we go to this one. Let's go to news.com. Here's an article. It's got nothing to do with the photo that's there. It's got a picture of that alien-looking dude from this platform that we're playing from. It says here, United Furniture Industry sacks all 2,700 workers while they were sleeping. Let's have a look through this. Big US furniture company this week fired all of its 2,700 employees while they were sleeping, telling them in text and emails not to come to work the next day. The mass firing by the United Furniture Industries, which makes budget-friendly sofas and recliners in Simmons Upholstery, left thousands of employees, including truck drivers and factory workers in North Carolina, Mississippi, California, unemployed just 2 days before Thanksgiving, right? Just before their little holiday over there, right? The instruction of the board of directors, we regret to inform you that unforeseen circumstances, the company has been forced to make the difficult decision to terminate the employment of all of its employees effective immediately on November 21st. This is not tech, remember. What's it say here? United Furniture Industries sacks all 2,700 employees. It's happening everywhere, right? Let's go and have a look here. If people don't have their little ATM money printing machine calling their house that they're going to be pulling equity out of, right? Money doesn't float around. This I've heard about a little bit beforehand. One of the community has said that works at Bunnings says that there was this potentially happening before now, but it just goes on to say hundreds of jobs cuts expected across Bunnings chain. The hardware retailer, major employer of tens of thousands of Australians, is expected to make some tough calls on jobs. And then you see this little picture here. It says here, Wesfarmers concerned with the new IR laws. Hardware giant Bunnings reporting to preparing to cut up to 300 jobs. Reports that 300 jobs in training, communication and support services could be on the chopping block, with a round of redundancy forecasted for its head office and national support centre. However, it is understood that Bunnings disputes the reported figure. Sources reportedly told the Australian the cuts could come through attrition and not filling vacant roles in the coming weeks and months. So there's Bunnings, and what else have we got here? We've got one more article, and then I'm going to watch our video and go through what is happening out there and breaking down what could seem as very technical stuff and talking about it in a layman's term. This one here is banks move to help residential property investors borrow more. So going back in 2016, the property market went into a recession. A lot of people are thinking that the property market in 2022 is going into a recession. The real recession occurred in 2016 when APRA tightened all of the lending. You might remember that there was a Royal Commission which went in, and basically everyone said, oh, they're checking out the banks, they're making sure that the banks are compliant and they're going to do the right thing. Well, the banks did nothing, right? The banks did absolutely nothing. That was more merely a stress test to see what the banks could support in a pressured situation and what could transpire from that. So here now, imagine we had all that stuff years ago. Interest rates came down, so they had to put a few extra measures in, because if interest rates went down to 10 basis points, which is nothing really, and that would mean that everybody would be able to service for a loan. So they introduced things called the household expenditure measure, which is HEM, and certain things like that, which made it more harder for people to be able to borrow. So there's still hoops for them to overcome. Otherwise, everyone would have been able to buy a property and get a loan, and it would have caused a hyperinflation from them just printing too much money. But now that we've got interest rates going up, they've got to find a way to be able to keep that money printing going through. So we've got here an article saying that the banks move to help residential property investors to borrow more. The NAB is the first lender to ease borrowing terms by including more of the rent in its loan calculations, right? Why would they include more rent, right? It goes, you think about this, right? It is getting easier. It is getting easier for residential property investors to borrow, with NAB, the first of the big four banks, to increase the proportion of rent that can be used to qualify a loan or seek a bigger loan. Um, Ben, whatever the guy's name is, with his kid here, among with many investors whose borrowing capacity has been squeezed from about 850k down to 500k by 7 months of successive rate hikes. The value of borrowing by investors around the country has slumped by about 25% since the interest rate started rising in May, having peaked at a record high of nearly $12 billion 2 months earlier, according to analysis. NAB is increasing the proportion of the rental income used to calculate the borrower's capacity to service a loan from about 80% to 90%. So now it is reported that the banks are allowing you to use 90% of your rent. But why would that be the case, right? When we're living in a world where costs are going up, right? Council rates and all those costs, wouldn't they be calculating less? They just need to have an excuse to be able to cook their books and be able to print loans and print money and be able to lend that money to keep the big Ponzi scheme of cash going through the system. What I think about is I'm always thinking of the long term, right? They just don't go and change the interest rate. They don't go and change the policy and then change it back next week. So what I'm trying to figure in is that if we're looking at the numbers that these interest rate cycles last for 18 months, 6 months, 6 months, 12 months, whatever the case may be, are we going to be sitting here in 6 months or 12 months' time looking at a position where the interest rates have dropped, and they have always dropped to a lower point? You notice that when the interest rate goes up, it comes back here, it goes up, it's come down lower, it goes up, it comes down lower, it goes up, it comes down lower. So every time there's new lower lows that are occurring when interest rates occur. So when you see interest rates are way out of line, what's going to happen when it comes back down, right? But when that comes back down and you overlay it with the fact that lending policies have gotten a lot easier and a lot less stringent, that adds up for a big party, right? Because imagine interest rates going back to where they were, but then it being much easier for you to be able to borrow, and you add an extra rental income because rent rises and stuff like that. That's going to spur on the next big boom. And that is what you invest for, is that you're building wealth. Anyway, there goes that. I'm going to get into a video. And this video here, I've posted in the Birch feed. If you are not on Birch feed, I send stuff out at random times of the day. Check out the website. It's birchfeed.com. That's it, birchfeed.com. Go to birchfeed.com. You can subscribe. It's free. You don't have to pay anything. Just get your data and, you go in there. I send stuff. That's it. So there's no credit card and ask for anything. That's all fine. So I've posted this video. It's from a guy called Maneko64. He's a YouTuber, and it's about a half an hour interview with this guy who, he's a pretty, what would you call it? The opposite to me, right? The intellectual guy from, has a lot of scholars. He's a scholar, right? But let's listen to the video. I'm going to pause it. I'm going to talk about it and break it down to simple layman's terms and talk about the things that I've been talking about for the last few years. When people sit there and they write in the comments of my videos going, "Oh, Birchie, interest rates are going to go down. Oh, you got it wrong, didn't you?" No, I haven't, right? And, short term, there is glitches. It's not linear. And I'm not even trying to prove anything here, but I'm just trying to go a bit deeper for those of you that might have questions or concerns and go, well, interest rates, where are they going to go to? Are they going to go all the way up, right? I'm pulling the data, I'm sharing it with you. I'm looking at stuff. You ain't finding this stuff on the news, right? You see, yes, the news, one part of the picture, but that's a very small, you see the Kim Kardashian, you see all these other actors on there as well. They read from a script. Here you are listening to actual, academic scholars. So let's listen to it. Where are we?
Go into a crisis or a country is going to go into a crisis. It might be the UK, it might be Italy, it might even be the United States, but something is going to happen. Things are very, very taut in the financial world at the moment. When that happens, I think they will close the banks. You'll wake up on a Sunday afternoon or Sunday morning and hear the news that they've shut the banks. They're not going to open on Monday, and then by Monday evening or Tuesday, you'll get the announcement that we're having a new currency, the CBDC, and don't worry, it'll be 1-to-1 against the old currency. But there'll be some restrictions on your ability to convert your old money into the new money.
November 24th, 2022, Monaco 64, home of alternative economics and contrarian views. So today I have the pleasure of speaking with Clive Thompson. He's a retired wealth manager for one of the biggest private banks in Switzerland. He's based out of Switzerland, but I think, of course, he's originally from the UK. And he's written some interesting articles on LinkedIn, and he follows me on LinkedIn. And he's written about the Federal Reserve, its balance sheet, the fact that they're making huge losses now. So we're going to talk about that. We're going to talk about CBDCs as well, and gold and silver, because Clive is a stacker. So Clive, welcome to the channel.
Thank you very much. Shall we start with the balance sheet of the Federal Reserve? If we step back to about 2011, the Federal Reserve had assets of around 2 trillion and a capital reserves of about 40 billion. So back then, the leverage on the balance sheet was about 50 times, which is quite leveraged. Right now, they've got over 8.5 trillion of assets on the balance sheet, and their capital is still about 35 billion. So they're leveraged over 200 times. In any financial institution, that is a situation which can go seriously wrong. And where I think we've got to is it is, in fact, going wrong. We've got two big problems at the moment on the balance sheet. The first one is their assets were purchased over the last decade when interest rates were very, very low. So they're mortgage-backed securities and treasury bills and treasury bonds, probably yielding something of the order of 2.5%. That's a guess, I don't know. But at the same time, the liability side of the balance sheet is the deposits from banks and depository institutions, on which they'll be now paying about 4%. So what's happened is first of all, they're mismatched in their maturity. They have long assets with a long maturity and a low interest rate, and they have short liabilities with a high interest rate. That's a loss-making combination. And in fact, the Federal Reserve is reporting on its balance sheet as we speak that it's making losses for the first time in its history. So that has the propensity to go wrong, because if they keep making losses, sooner or later on the income and expenses side, they get a run out of capital. Already their reserves have been depleted, and they're showing, actually, if I look at the balance sheet, they're showing a negative reserve of $9 billion, and that is only going to get bigger as they make losses going forwards unless they lower the interest rates. The other issue that the Federal Reserve has got is this portfolio of bonds that it bought over the last decade. We all know that bond prices have fallen a lot. I'm going to say at least 15%. So on the 8 trillion of assets, you can see that even a 10% fall in those assets would be 800 billion, compared with their share capital of 35 billion. It will have, on paper at least, have wiped out that share capital. Technically, that means that the Federal Reserve is insolvent. Insolvent is not bankrupt, and it's only paper losses, and they can get that back over time. But where we've got to today is a situation where the Federal Reserve must be talking to the Treasury about how they're going to recapitalize the central bank. You can't carry on forever with no capital and no reserves. And if I was Goldman Sachs or JP Morgan, I would have some concerns if I'm making deposits into an insolvent bank.
So that's just a part of it, right? I want to break it down into its intricate detail, right? This is the US Federal Reserve. And just going back on what was being said there, um, back in 2011, there was $2 trillion of assets. What an asset is a mortgage to someone, right? Because it's a loan that needs to be repaid, but with the actual backing of $40 billion. So now that's gone up to $8.5 trillion, right? With 35 billion. So the assets have depleted, but the liabilities are, it's far exceeding. So if we've now got a liquidity issue, you've got to remember that a bank only makes money from renting out money, right? So we're at a position now where we're basically at zero profits. These bonds have been taken out, which are now in negative territory, right? So they're losing and bleeding money. The higher that they go up, I said at the start, the countries will go bankrupt, the companies will go bankrupt, the banks will go bankrupt. There will be a bailout, in my belief. We're going to see some style of GFC happen, right? Unless they turn on those money printers. And when they turn those money printers on, it's going to do one thing. We've already seen what happens when they put the money printers on. They haven't even been able to turn the money printers off for 6 months. They haven't even pulled the liquidity out of the market yet. But what happens when they start, having to re-inject it in? We've seen hyperinflation, we've seen levels of inflation, but when they start re-injecting liquidity in the system, that's where the whole fun starts. So um, a lot of people are fearful. I can see a few comments in the section saying about um, one person Josh, I need to have a chat to you. So I'm going to make sure that my team calls you and organises the chat so we can chat about your position. But you know, it's not a recession that people are just going to feel. People are going to feel the recession. The businesses are going to feel the recession. This recession hasn't reared its head. We haven't seen it on the news yet. We haven't seen things blowing up. But I want to know how, if you just think about your household, right? You're earning, I don't know, 50 grand, 100 grand, whatever you earn. Let's say you got 100 grand, just making it up, right? How 100 grand household income, and your expenses have all gone up by, 20%, 10%, 5%, whatever percentage has gone up. People are at, a breaking point out there, right? How is this going to go on? So if people aren't going to be spending money out there, well, then the businesses are going to suffer, and then that's going to cause further losses to the businesses, further losses, and basically everything that's being created going up is going to come down even faster. And you can see, just by charts, right? Like some of these times when interest rates have gone up, they go up in small amounts, but when they come down, that is literally the cycle that we're going to be seeing. The banks and the institutions only make money by renting out their money, right? They need to keep that efficiency happening. So if we're tightening a cycle which has got this big Ponzi scheme of debt that's attached to it, it's either going to go and implode on itself, or they've got to prop it up and set it off like a bloody rocket ship. So that is, the interesting predicament that this is talking about the US Federal Reserve. It could be any central bank around the world. I believe when we start looking at the central banks, whether it be Australia, like with the RBA or whatever, they will all crash, right? They will all crash in the eventual part of this. And a lot of people talk about a one world government and a new world order and those sort of things. Um, I believe we're going to see a bail-in into the market using a central bank digital currency, which is the only way that they can track and trip and trace everybody. They've been testing this stuff out for a while, like a social credit system. It will be global, and it will be originated from the IMF, which is the International Monetary Fund. So I believe that the central banks will need a bailout, and those central banks will need to bail out the retail banks. So it will cause new lending of new bonds to originate from the International Monetary Fund, basing off of SDR, which is a special drawing, right? I don't want to go and complicate things too much. But yeah, so um, Mark says here, a bail in. We've been in a recession for years. One, growth through creative book world didn't keep up with inflation exactly. They should change the RBA governor's name to a chef, right? Because they're just fucking cooking the books. That's what they're doing. But let's get back to the video. There's lots of interesting points in here. I want to share it with you. These are not things that you would hear generally on the TV. This is not stuff that, these are very academic people, right? These are people that have been in the industry for decades, right? These are people, they are a bit negative about things, and they are very bullish on precious metals, and like I am too, but I'm not, I'd never sell a house for precious metal. I've been collecting this stuff for decades, right? And but fundamentally, I look at this and I see, okay, every time there's adjustments out there in the financial markets, things that occur when you're looking at rate manipulation, or we're looking at liquidity coming in and out of the markets, there's things that get inflated, and there's things that they can't let pop. And if they do, then everything gets wiped out. So, yeah, let's get back to the video.
We are at the moment. From a simple layman's point of view, it's as if you have an income of $100 and you have a mortgage going out of the door of $200. You're making a loss and you can't continue until you're forever, because sooner or later your capital runs out. Now, the central bank's got another problem, and that is its policy. It's a avowed policy of quantitative tightening. Quantitative tightening means they want to reduce the size of their balance sheet. There's two ways.
I've been talking about this with you guys before May this year. I said that they're going to tighten their balance sheet. We've gone from quantitative easing, where they're putting it out there, and we're going to quantitative tightening, which is where we're at the moment.
To do that, one is the simple runoff by allowing government bonds to mature and taking in the cash. And the other way is a little bit more faster by selling bonds. To the extent that they sell bonds, they're going to be crystallizing those losses, and they won't be paper losses anymore. They'll be realized losses. So it's a very, very difficult situation for the central bank to deal with. And what they really need, what they seriously need now, is more capital. And the Treasury would be.
So how would they make the new capital, right? If they are selling their bonds because they need to recapture liquidity. So it's like, imagine you've got a house and it's $1 million, and you've got a loan on it for 800 grand, and you sell it for 600 grand. Yes, you are getting 600 grand in, but you are crystallizing that big loss, and then you've got to sell something else to cover for that loss, and it creates a collapse in the liquidity market. So that's
the obvious candidate for the capital, because the only beneficiary of the Federal Reserve has always been the Treasury. What happens in practice is that the Treasury receives all of the Federal Reserve's profit, but is not receiving anything at all now, because they've stopped making a profit, they're making a loss. So now it's only just a question of time before something happens. I think the Federal Reserve will be asked to put in capital, and I don't know how the American taxpayer is going to see that, because the Federal Reserve doesn't actually have the money to put it in.
Yeah, and on your article here at the end, you put a transcript of Ben Bernanke, the winner of the Nobel Prize for Economics this year, and it's weird to say that. And he was testifying in Congress in 2011 here, and one of the congressmen, Chairman Conrad, asked about this, and he said here, the reason I asked the question and phrased it like this, because in common parlance, there has been a great concern that what the Federal Reserve did was going to result in large losses to taxpayer, or there was the potential for that. And you do not see that. And he answered, I do not see that as.
That they're making losses, and those losses have to be funded by the taxpayer. There is nobody else who's going to put the money in.
No, and I think the reason this is
taxation is theft, but as is inflation. Inflation is a hidden tax. The only way that they can get through this is by printing their way through this. If the debt becomes relevant with inflation, you can make all the debt go away if you lose the currency, which is the only way for this system to be able to continue on in the way it is, which means it's a debt forgiveness, because the debt becomes irrelevant with inflation and everything gets sucked up in the vortex. And I've said all along that there'll be a point when I'd want to pay out my mortgages. It's when I can have a Big Mac meal, or I can pay out a mortgage on a medium family home. You know, it's at that point that you'd want to pay out your mortgages. But that is a point where we will be getting to in the future. But let's get back to the video.
Happening is because most of these central bankers and Wall Street and the city, they thought that interest rates were going to stay low forever at zero or even negative. And no one saw the consequence of higher rates, of rates going up as quickly as they are. And maybe you could explain to the viewers why.
So just thinking about that, right? I know that some people might be watching. They go, well, yes, my interest rate's gone up. I've been concerned, whatever the case may be. Just understand, if you had a problem with your own situation, it would be very lonely, right? And I've faced adversity over the years, right? I've faced heaps of adversity over the years. But when you're going through it yourself, well, then it's bad, right? But when everybody goes through it, collectively, everyone's going to blow up, or everyone's going to be, they've got to create something else. And that's where the next level of this system, the next level of the Ponzi scheme goes to keep that party alive. Because if someone dies, that's okay. But if everybody does and you lose, 50% of the market or, greater, if there was, the banks are so far leveraged now that it would wipe out the banks, it would wipe out the stock markets, it would wipe out every business, it would freeze all financial markets. And that's what I find so exciting, because they have no option apart from having to keep printing. And that's what's going to cause higher levels of inflation.
That is exacerbating these losses.
So what's happened is the central bank has to pay to its investors, that's the depository institutions, in other words, banks. It has to pay the market rate. And it recently put up the rates 3 or 4 times by 0.75% from below 2% to now we're at 4% on the Fed funds rate. So the depository institutions are receiving a rate of about 4% on their deposits. That's on the liability side of the Federal Reserve's balance sheet. On the other side of the balance sheet, they've got their assets, which are the bonds and the treasury bills and the mortgage-backed securities, which will be paying a lower rate than they're paying out to the banks.
Checkmate. Checkmate. Every part of the system is screwed. I will encourage anyone to have a great debate about it, and I'd be happy for haters or whoever. They go, oh yeah, but this, or I've listened to the guy on the news or whatever, right? Mathematically, show me how it's possible for them to get out of this situation. The central banks are losing money. Just put that into context. The people who make the money are now, their business is going bankrupt, right? So the whole financial system is going bankrupt. The only way to save it is there's 2 ways. One is to do the honest thing, and it's to blow up the central banks, right? The honest thing would be, let's go into a recession. Let's go into a depression. In 1992, Paul Keating, who was the Prime Minister of this country at the time, everybody hated Labor, right? Everybody hated Paul Keating. They go, because he said something. He said it was the recession we had to have, right? I'm politically atheist, right? I used to be very liberal. Politically atheist because they're puppets on, I don't want to see the wings of the bird. I want to see the bird, right? I want to see whose hand is up these politicians' rear end to make them talk and do those sorts of things. And you can follow the money back and see those things. But this Paul Keating bloke probably said the wisest thing out there in a time which was probably not the right thing to say, which I think he probably regrets going back. If I was him, I'd want to regret that as well. The recession we had to have, right? And the honest thing would be to let it all blow up. The fraudulent thing would be, let's keep the Ponzi scheme growing until it gets out of control. And savers will be losers. You're starting to see where people, they have cash. The cash is just getting vaporized. And that's what will happen during a hyperinflation. So I encourage you to think, the charts, the data, the stats, the numbers. Yes, it can look scary. You're looking at 6 months of a cycle. What happens greater than that, right? What happens in 12 months' time, 24 months? Your journey of life is not 6 months. Your journey of life is not 12 months. It's not 24 months. How are things going to play out over the longer term, and what are the opportunities for you to be able to take advantage of all those things on those cycles, on the up and the down and the sideways? So
I think just something to say about the mortgage-backed securities. That's where the whole world went wrong back in 2008. The Federal Reserve still has several $billion of MBSs on its balance sheet. I'm just having a look here.
Yeah, I've got it here from your articles. I think it's 2.7, isn't it?
That's something like that, yes.
2.7 trillion. There you go.
So that type of security goes down in value rapidly because it's linked to mortgages, it's long dated, and when rates rise, people default on their mortgages. Now, in this case, it may not seem like a big problem for default because these securities are guaranteed by Freddie Mac and Fannie Mae, which are now, to all intents and purposes, government-owned institutions, or let's say government-controlled institutions. But it is a problem because we mustn't forget that Fannie Mae and Freddie Mac both went bust back in 2008, and if it wasn't for the government diving in and saving them, investors would not have got their money back. So the net result is now we've got the Federal Reserve owning a lot of these mortgage-backed securities, and the government, to all intents and purposes, is through the back door guaranteeing them via the guarantee of the Fannie Mae and Freddie Mac. But it's a leverage situation which has the propensity to go wrong.
Yeah, and I think the Chinese had a lot of mortgage-backed securities in '08, and it was one of the reasons why they had to bail them out. I don't think the Chinese would have been happy. I mean, one of the solutions, but that would make the Fed lose it doesn't have much credibility for me, but for the public, if they were to basically not publish these numbers anymore and people couldn't see where the Fed was, do you think that's possible? I mean, that would be very banana republic like.
Well, it wouldn't surprise me. You may remember way back, must be 20 or 30 years ago, the Federal Reserve used to publish the M3 number, and we all sat on the edge of our desks on Thursday afternoon waiting for Paul Volcker to announce the M3 number, because whatever the M3 number was determined whatever was going to happen for the rest of the week in the financial markets. And the Federal Reserve, in their wisdom, suddenly decided that we didn't need to know that number, and they stopped publishing it. So we don't know that number. We have some shadow numbers produced by other firms now, but it could well be that they decide to stop publishing information that they think we don't need to know.
Yeah, and going to gold and silver a little bit now, because if these losses continue on the Federal Reserve's balance sheet, and I think they will, because I think
if you put the Federal Reserve or any of the reserve banks that are going into a loss here, just think about it, what they are technically doing, right? If you were bankrupt and you had a 10 grand credit card that you have $1,000 credit card you can't pay off. You go to the bank goes, well, instead of going bankrupt, what we'll do is we'll increase your limit to $10,000, and that means that you've got extra cash flow flowing through, and then we can you can live off that, and you can get yourself, and everyone goes, okay, great. And then you get to a point where you can't pay the interest, you can't service the 10 grand one, and it's exacerbating as you add an extra zero. It just becomes, there's no second job that's going to fix that up for you. That's where the central banks are at right at the moment.
The bond bull market we had from 1980.
We are now. I'm down 10, 20, 30% on my bond fund after X years. What's the point of holding it? So I think over the next few years, we're going to see a drift out of bond funds by everybody who ever had one. They're going to say, this just isn't working for me. It's not doing what's written on the tin. It's not bringing the stability to my portfolio. And they're going to come out of bond funds and look for other things. And I think gold and silver will be one of those things that people...
They talk of gold and silver, that's what they love talking about. However, when you think about the bond fund, where are the bonds, right? Where are your bonds stored? Who invests in the bonds, right? Do you own a bond? Does the next person own a bond? Out of all your friends and family, who owns a bond, right? People don't just go out, I just went and invested $1 million in the bonds, or whatever the case may be. people don't realize, but they've got 10% of their income that they've earned over their life, which is stored into bonds via their superannuation fund. So a lot of super funds invest in the bonds and prop up the bond market using that. So when you see that there's a compulsory super, right, is that compulsory because it's there to help you? Right, and you always got to question, where's the government coming from when they're there to help you under the guise of something to protect you, something to look after you, because the last 24 months has really shown you that they don't. Otherwise, they'd tell you good nutrition, they'd tell you about how to exercise, they'd tell you how to build your immune system up, but I've never once seen that on any sort of media publication. They just tell you, here, you better take this. So when you look at the here, you better take this, which is sent out via their agents, being the financial planners, the financial advisors via their institutions, you've got to start questioning, okay, why did they build a superannuation fund? Was that a new Ponzi scheme that they could wrap up from the outside to put new people to invest inside of that Ponzi scheme? And people don't even realize they're walking around today, they don't know what they've put in their body, they don't know what they're eating on a daily basis, they don't know about the chemicals, and they don't know where the fuck their retirement fund is invested into. And that's very, very scary. And you should be asking those sort of questions. You should be like a child, but society teaches you to, shut up, don't ask questions, sit in your corner, stay in your lane, don't do certain things. Where you should be adventurous, you should be, seeking questions, seeking opportunities, and seeking things. So, yeah.
Start to put in their portfolios as a substitute for the bond funds. Now, I'm not saying we're definitely going to have a rush for the exit in the bond market, but there's a lot of people sitting very, very close to the exit, and we might see a surge of sellers, and that will drive down bond prices. Because if you sell your bond fund, it doesn't matter how good the yield is. The bond fund manager has no choice but to sell the underlying into a market which doesn't want to buy it.
Yeah, and the modern philosophy, and you know this because that's what you used to do, wealth management. Maybe you can tell the viewers, is a balance of 60-40. Isn't that, and 40% is usually bonds, and 60%.
Don't want to bore you
accounts,
too much.
But they're not audited. Yeah. But I think any auditor would be having kittens when they saw this.
Yeah. So the 60-40, could you touch up on that?
Country is going to go into a crisis. It might
go replace them for a system that's dying, the fiat currency systems, but maybe you've got a different opinion on it.
Well, I think it's quite likely that the CBDC will arrive, and it will also be the subject of the currency reset at the same time. At some point, the world is going to go into a crisis, or a country is going to go into a crisis. It might be the UK, it might be Italy, might even be the United States, but something is going to happen. Things are very, very taut in the financial world at the moment. When that happens, I think they will close the banks. You'll wake up on a Sunday afternoon or Sunday morning and hear the news that they've shut the banks, they're not going to open on Monday. And then by Monday...
That would never happen. They would never shut down all the financial institutions. They wouldn't take away all your ATMs. Tell me, how many ATMs did you have in your neighborhood 2 years ago? How many ATMs do you have in a year ago? How many ATMs do you have now? Oh, please pay by card. Please pay by digital. It's for the health. It's for the good of everyone. But you can't go get access to your cash. Where's your cash gone? You don't have any access to it. So, you wouldn't have thought that they would lock you in your house, force you to do things that you don't want to do with your body, right? Other people, if you took them to court, you could charge them and they could go to jail for doing things to your body. But no, when these guys do it, you would never have pictured that coming, right?
On Tuesday, you'll get the announcement that we're having a new currency, the CBDC, and don't worry, it'll be 1-to-1 against the old currency. But there'll be some restrictions on your ability to convert your old money into the new money.
Communism?
So if you're poor and you have a small bank account, it'll be converted 1-to-1 straight away. And you'll probably even find that you get a free gift from the government to kickstart the system. Maybe £3,000 or £5,000 will be given to every citizen gratuitously to kickstart the system in the new CBDC. But if you have 100,000 or 1 million in the bank, you're going to be told, yes, it's 1-to-1, but you're going to have to wait to convert it to the new currency. Now, wait means never. We all know that, but they won't tell you that. They'll say it's a temporary suspension because we're in the middle of a crisis. The people are rioting in the streets, and we need to calm the system. So
Mark just said here the banks have already closed all of its branches. Whenever you see a bank close its branch, just say we're temporarily shut down. We'll be back soon. Your closest branch is this one over here, 5Ks this way and 10Ks that way. You see that happen, and then about 3 months later, you see that the shop has a big boards around it, and it says new place coming soon, and the bank has gone in the dark of the night. They never told you that they were going to take the bank away from you, right? How many people have had their bank account closed, had garnishes in their banks, had certain things happen? This here is very, very bad, and that's the thing that I'd be more concerned about. But you're trying to free yourself from the system. You're trying to free yourself from dependency to the system. You're trying to create as many opportunities for yourself so you don't have to rely upon the system or take part in that system. And just before I go back to the video, Mally said, if the banks blow up, is there a possibility of them claiming every asset that the mortgage is linked to? It's important to understand that everybody is just looking two-dimensional. Oh, the house is the asset. The house is the asset, right? The house is not the asset. The house is not the asset. It is a part of an asset. It's like saying you can't play chess without the pawn at the board, right? You can, right? You take the pawn off, you still got all the other pieces. The property is just a piece of the chessboard. The real asset is that each one of us is a human. If you go and look at a mortgage is Latin for death contract. It's a contract to your death, right? And it's to be able to control you. The asset of the bank is not the property. That one asset of the bank is the property. The other asset of the bank is that the person taking it up has got 40 years of working as their slave to be paying that interest off, right? And me, I like to leverage. So I'll leverage the debt and I'll take the debt on, but then I'll outsource that debt to someone else to pay for it. And I'll just control the asset on the middle of it, right? So I'm just a part of the system, just like most of us. So if the banks blew up, no one would have money to be able to go and buy the assets. So the assets would be deemed worthless, i.e., if you're looking at it two-dimensionally as a bank, so as a property. So the properties only have value. The system has to be supported. If you took the chessboard away and left all the pieces, there would be no opportunity to play a game of chess. So they need the chessboard in place. They need the certain things. They just want to try and conquer the land and own as many pieces that they can. So
free money, everybody. Go and enjoy yourselves. And by the way, the rich can't convert their money for a while, but they'll be able to do so later. So if you happen to own Apple bonds, they'll be denominated in the old dollars. You won't be able to, it'll still be old dollars. You won't be able to convert those old dollars until you've got the cash. But when you get the cash, you'll need permission to do it. And you're not going to get that permission. It'll be exactly like we had in Britain back before 1975, when we had the exchange controls. You needed permission from the Bank of England. I mean, I remember when I travelled abroad the first time, I was allowed to take £50 with me abroad. Didn't go very far.
No, and yeah, sorry, go ahead.
So I think when the CBD, I think the CBDC will arise as a consequence of a crisis, and when that happens, there will be a limitation on how much of your old currency you can convert at 1-to-1 with the new one, even though technically it'll be 1-to-1, so you've lost nothing. But the advantage of this, from the government's point of view, is it's to all intents and purposes wiping the slate clean, because all of their liabilities will be denominated in a currency that nobody can use, nobody can spend. So if the
debt becomes relevant with inflation, guys. Debt becomes relevant with inflation. If you can't use your cash, who cares about the cash? If the cash is worthless, then what's the opposite of cash? The opposite of cash, there's two sides. Let's just look, I've got a coin here, right? Here's an old 50-cent piece. This is when there's a round 50-cent pieces from 1966. It's 50 cents. A lot of people may not know what that is, or it is. It's from 1966. It's the only year that it had silver, and it's 80% silver. But each side of the coin, right? It's like if there's light, there's darkness, right? I look in my office, it's all light. Outside, it's all dark. There's good and there's evil, right? There's two sides of the coin. So if you have cash on one side and the opposite of that is debt, then if the cash blows up, well, then the debt blows up as well. And when you realize that the cash that you use is debt anyway, you see that it all just gets removed. And if it all gets removed and it all falls apart, generally via hyperinflation, so everyone can pay off their debts, that is where the opportunity is. You want to be holding the assets and paying the debt off with a Big Mac meal, basically. And when I say you can pay your house off with a Big Mac meal, I'm probably being a little bit too extreme to that. So just in case someone tries to mince my words up, but you get my theory behind it, right? Like research hyperinflation a bit more.
People rushing to try and convert their money into something, into anything, firewood or whatever they're trying to do, they won't be able to use their old currency unless they are, the poor man will be able to use it. But anybody with any wealth, like the government of China, will be stuck. So the government will be able to print away its old liabilities without any worries at all, because nobody will be able to spend it and it won't be able to affect the economy. The only thing which can affect the economy is the new CBDC, which will be, at least initially, touted as very sound money, at least until they start borrowing in the new currency. But then they've got a fairly long lease of life, because they'll be starting from a debt to GDP ratio of effectively zero, because they won't need to count the old debt. Of course they will from an accounting point of view, but it won't be affecting the economy anymore.
So this reminds me of Argentina, I think in the early 2000s. A lot of wealthier depositors had US dollars, and then it was 1-to-1 to the Argentinian currency, and then everything collapsed and they closed the banks. And those people who had dollars were now given Argentinian government bonds. And they were also, it was called the corralito, and because a corral, the money was kept in the pen and you couldn't use it. And people were given the government bonds. They couldn't take over a certain amount of their money out every day. So basically, you're telling me that the CBDC won't change anything for people who don't have much, but for the people who have a bit of savings, even not just in cash in the bank, but even like stocks and bonds, those funds are going to be frozen under this CBDC.
There's no reason for the stock market to. The stock market might shut down for a week while the banks are closed, but there's no reason, if you own shares in a blue chip company, there's no reason why you won't continue to own them. And likewise, if you own a government bond, you'll continue to own the government bond. The difference is the company will still be worth something. The government bond, you won't be able to do anything with it. If you sell it, you're going to get some old currency that you can't and not allowed to convert to the new one. So to all intents and purposes, the old bond will be worthless. I think when they bring this rule in, when they bring in the CBDC, in the middle of a crisis and freeze your old currency, you'll still be able to trade your old currency, but you'll be trading it effectively through the back door, and you'll be lucky to get 70 cents on the dollar on day one, and 3 months later, 20 cents on the dollar, and a year later, nothing.
Yeah.
That's the crucial part. Also, if you remember, the Vatican City had requested that all funds get bought back in by September 30, right? Just remember these timings, right? They're not just by chance or by fluke or something unbeknown.
But even with, let's say you have some shares of IBM,
and he'll have a lot more money in his pocket to spend on other things. So in that respect, it'll be great for the economy, because the man in the street will have less outgoings. His mortgage will be effectively over a short period of time wiped out to nothing. So will his old credit card debt. And the same thing can apply to corporations. Almost all large corporations have got large borrowings, which in a currency reset will continue to be denominated in the old currency. And over time, they'll be writing down the value of those liabilities and booking a profit as they write it down as a foreign exchange profit. So it'll be very good for companies who'll be writing down their debt. It'll be very good for the government, who will no longer see their national debt as a problem for the economy. Be very good for the man in the street who'll have a mortgage which is now denominated in a currency which doesn't exist, and his credit card is wiped out, so he'll be able to start spending again. The government won't need to take money out of your pay packet to service a national debt, which it doesn't care about anymore. So I think actually once we pass the reset, it'll be very good for the global economy, and we could see an economic boom, the likes of which we saw back in the 1950s when America was pumping money into the whole world.
And some people might say, what if they turn your old debt into the new they like make an exchange and you have your mortgage in CBDC? You don't think they'll do that? That would defeat the purpose of things going. Well,
that would be, because that would mean that the asset holder has CBDCs, which he can spend, and we mustn't forget that the crisis will be arising because people are panicking about the currency. They're trying to get rid of the old currency. If you convert all the old currency, and therefore all the old bonds and all liabilities and assets into the new currency, you're just converting old pounds for new pounds, and it's the same thing. So, no, I think the whole idea of CBDC is to...
Yeah, sorry, you're not solving the problem then, yeah? Sorry.
No. So I believe that monetary assets, fiat-denominated assets, will, to a large extent, remain in the old currency and not be converted. But they don't want a riot on their hands, so of course they're going to convert everything that the small guy owns. And so the small guy will be okay, but the government's going to decide who wins and who loses. And I guess it's not going to be the wealthy, and I guess it's not going to be the foreign governments, and I guess it's not going to be the foreigners.
And do you worry about the fact that they're talking about programming CBDCs? I mean, that's the tyranny. I know it's difficult to forecast when.
Is very telling, because I think that's where the world's financial system is. It's as near as it can possibly be to the end of the current state, and it's time for a reset. All the big institutions like the World Bank and the IMF are talking about debt forgiveness. Well, debt forgiveness, it's basically means don't pay, or debt restructuring, don't pay. So I think that's where we are, and I think 2024, 2023 will be years where this is quite likely to happen. I don't know which year, but I think it's very, very close.
Yeah. And
so my advice,
sorry, go ahead. Your advice.
I was going to say my advice is from the wealth management point of view. Stay diversified, but minimize your exposure to bonds, minimize your exposure to fiat, and increase your exposure to other things. And obviously gold and silver would feature in those other things. And I'm not going to say a figure or percentage of what's right for each individual. But I think there's one important thing I'd like to add, because at some point people are going to say I'm wrong. And the reason they're going to say I'm wrong is when we get to this currency reset, we mustn't forget that half the wealth on the planet will not be deployable. We're talking about the cash deposits, the bonds. It'll be worthless. When that happens, people will be forced to rebalance their portfolios. They'll be selling assets to get the new CBDC. That does mean that in the new currency, the price of everything will be lower than it is today.
I see. And no, I agree with you. Being out of anything that's denominated like a bond, government bond, and cash in the bank, that's the worst thing to have in a reset. I remember in Brazil, I lived in Brazil, and in the late 80s, they had a reset. And my uncle, he bought a property, and luckily he exchanged the contract on a certain date. So he paid the owner. And then the next day they did a reset. And the guy who sold the property, he was basically wiped out. And my uncle luckily had the property. So what else? Yeah, go ahead.
Just on Brazil, I'm not sure it's Brazil or Argentina. Didn't they have this situation back in the 1980s when the government decided that every bank deposit had to be loaned to the government apart from $1,200? I'm not sure if that was Brazil or Argentina.
But surprised me.
But if you were wealthy, if you had more than $1,200, they helped themselves to it and said it's a loan to the government at a very low rate of interest, 2%, when the inflation rate was in the hundreds. By the time people got it back a few years later, it was worthless.
Yeah. So just to finish off, I just wanted to ask.
Anyway, I think you get the picture. You can go trust your government. You can go trust your central bank. You can go trust your media, your TV. You can go get your knowledge from your Uber driver. You can go get it from your uncle at the barbecue on the weekend. Research. All these things could just be theories. We could all just, be happy and it's all just going to work out, right? But reality of it is that I noticed that someone made a comment about the 50-cent piece that I had beforehand, right? This is just 50 cents, right? You take it down the bank will accept it as 50 cents. It's like a 20-cent piece, and they changed it, put the, I forget what they call it, the whatever it is, the dodecahedron or whatever, the edges that are like a hexagon, basically. Onto it to make it not be like a 20-cent piece. But that's a 50-cent piece from 1966. If you were to sell that today, that's worth about $20 just for that coin, right? And that's because the metal is worth more than that. So if you look at the demise of our currency that we've had over the last 50 years, 55 years, we have seen our currency lose its value. What's going to happen is that's going to speed up even greater. Having cash, or that's not, or may not be, the best thing. I'm not giving financial advice. I'm not being a Philip Lowe giving financial advice like he did on the news, saying this is what you're going to, not until 2024. That to me is financial advice, right? I don't think anything I've ever given is financial advice. I just talk about theories, and I like to listen other people's alternative views on things, people that are very experienced, people that have a lot of knowledge, and that's things that I listen to on a daily basis to improve myself and to understand the matrix that we have. Yes, there's lots of other people. If I want to listen to someone talking about property and whatever, like I could learn something from them, but it's not going to allow me to get to hundreds of properties in my portfolio, hundreds of millions of dollars worth of net worth. It's going to have to come from understanding how things work, and then making decisions and backing myself based on the knowledge that I've got in order to take decisions and make the best out of those opportunities. So I encourage everybody. It can seem scary. If you think 2022 has been scary, 2021 is the most scariest year because of what they forced everyone to go and do. 2020 was probably scary because you didn't know what you were walking into at that period of time. But looking and being alert and being awake and being in tune with what is happening out there, being questionable, just like a child, they question, what does this do, mummy? What does this do, daddy? What does it happen? As humans, like as adults, we don't have that. We just go, oh, well, we accept this. This is blind faith. This is blind trust. And it's very few and far people that are questioning things that are out there. I encourage everyone to question it and calculate and run scenarios. Like my life is a mess, right? Like I think I've got maybe like ADD or something, right? But I've got messes everywhere. It's very organized messes. I plan. I draw little doodle things. I don't draw doodles, but I doodle things and draw and jot down scenarios and sort of reverse engineer things to be able to come up to conclusions of where things will be at, and that's based on all the data, all the opinions. If someone said to me, by putting a foreign substance into my body, right? Let's just assume that this is not a screwdriver, and you had to roll up your sleeve and go, oh, let's put this in here. And if someone could have a valid argument and be able to explain everything, well, then maybe you'd start questioning, going, oh, that sounds good. But when you can't have that discussion and you're being told one part of it and the other information is being hidden, it's like, well, why is that being hidden? And when you're looking at these financial markets, these guys have got it wrong so many times, but they're the ones that are allowed to be put into the media. When I go to any channel, and when I go to any news outlet and I start talking about these sorts of things and these sorts of scenarios, it's not backed by the advertisers, it's not backed by the mainstream rhetoric. And it's labeled as conspiracy or whatever. But like when I said these things were going to happen years ago, it was conspiracy, but they've even happened. And now people might be saying, "Oh, you're edging on the conspiracy theories." Well, I'll take my stand, right? I'll take my stand. I'll take my position, and I'll back myself on that, and I'll keep delivering you the content based on this data that I see out there. So that's all I can offer you guys. If you do want to see more about where I do get my information from and where I do research, and I do share things around on there, sometimes random things, right? I'm actually going to share with people in Birchfeed about aquaponics shortly. So I'm going to share some links. I'm setting up some aquaponics. Um, what aquaponics is basically you can set it up with like an IBC container. You put it's like the pallets which have the 1 ton of water on them. You can cut them up and convert them into a pond with growing your own food. People are questioning me, asking me the question. Nathan, you said a few months ago that they're going to put a certain chemical inside of the animals. They've got to be injected with a chemical. It sounds like the NRMA, but it's more like a MNRA. And people are concerned about next year what happens to their food. Well, you want to control your food supply. So I share random stuff. I research things. Generally, it's around what I'm interested in at the time. And I share that. I watch things and I go, that's cool. I see value in that. If you do want to be a part of it, just go to birchfeed.com, birchfeed.com. Subscribe. I put random stuff there, a little bit more conspiracy theory than people would like to see normally. But it's where I get my knowledge from and I like to share it. So if you do want access to do that, if you want help to navigate yourself through the environment that we're seeing at the moment, I think there's only two options that's going to happen. We ain't going to see a normal world where we just go back to 5%, 6% interest rates and everything's okay. They increase the interest rates, they take the liquidity out, the central banks go bankrupt, the governments go bankrupt, the corporations go bankrupt, the people go bankrupt, everyone blows up. Or they just turn on the printers and they cause a hyperinflation. And it's not just me coming up. There's a lot more people that are more academic, more into that data. I just look at the data, analyze, and go, hang on a second, that one makes sense. This one doesn't make sense. So be it. And I make my decisions based on that. So if you do need help on working on your strategy, building your strategy, there's a link in the description. Reach out to my team, have a chat with one of my investor relations managers, see what we can do. Everybody's position, there's not one person that's watching this video that can't improve. Even myself on the other side of the camera doing this video, I can always be improving my own personal position, doing certain things, tightening this, doing that. What can you be doing? And in a world with a lot of misinformation out there today, it's hard to go and get answers or get data because everyone's just being fed certain sources of data. So if you do want to have a bit of an alternative view on your position and see what you can do, reach out to my team. The link's in the description. And on that note, I'm going to go home. Got lots of emails to reply to, and I'm pretty hungry. So we'll catch up soon, and I will see you next week. Cheers, guys. Bye for now.